Hi, my name's Roger Schluter. Uh, this video is actually about the bridge loan. It's actually a pretty short video, but anyway, and then at the end, I'm going to show you a couple examples of some bridge loans, but I'll probably talk about them during the video too. Anyway, the bridge loan. Bridge loan is also known as an interim financing or gap financing. It is a short-term loan that provides temporary financing until a more permanent or long-term solution is obtained. It really bridges the gap between immediate need for funds and the final arrangement of a larger loan or financial transaction. Before I tell you about the attributes, the biggest way, and I'm going to go into this a little later, the biggest way it's used is in real estate. Let's say you own a house and you want to buy another house. So you could sell your house and then look for another house, but you may actually be, outdoors because you may sell the house before you buy the other house. So the real way a bridge loan works is they figure about how much you're going to sell your house for when it does sell. They can estimate it, and then they will go ahead and give you that money to buy that new house. So you buy the house, you move in while you're selling your other house. So there is no, you're not out, living outside or having to live at a friend's or having to go to, somebody else's house to live for a few months while you sell your house. So anyway, it works out very good. It works in, that is the way it works in individual housing, and then also in industrial or in, I guess, commercial lending, and in commercial loans for real estate, it really works out there very well too. Anyway, here are the attributes of it. Number one, short-term nature. Bridge loans are typically designed to be repaid within a relatively short period of time, often ranging from a few weeks to a few months. We could be talking, they can extend up to a year or more in some cases, but usually it's a short-term loan that is used, for this purpose. Number two, interim solution. Bridge loans are used to cover the immediate financial needs, such as purchasing a new property, before selling an existing one, or securing funds for a one-time sensitive business opportunity. Let's say you get this business opportunity and it's just like you need the money right away, but you're going to get, either sell it or do something else with it to get money to pay it off rather quickly. Then it can be used for that. Quick approval and funding. Bridge loans are known for their expedited approval process and faster access to funds compared to traditional loans. That makes them suitable for urgent financial requirements. Number four, higher interest rates. Due to the short-term nature and potential higher risk involved, bridge loans are often come with higher interest rates compared to long-term loans. On collateral. Bridge loans may require collateral such as real estate or other valuable assets to secure the loan. They always will. Number six would be customized terms. Bridge loans can be secured with a various repayment options, including interest-only payments during the loan term with a balloon payment of the principal at the end. Number seven, common in real estate. Like I said before, bridge loans are commonly used in real estate transactions, such as when a home buyer needs to secure a new property before selling their current one, or when an investor wants to acquire a property quickly, and then he knows he can either sell it or rent it out or do something with it later. Usually, after since it's a bridge loan, a lot of times they'll use it until they can actually secure the long-term financing for that project. And that makes it a little bit easier because you're not rushed to get something for the property. Banks don't like it when you're rushed. They always think you're pulling something over on them. They like it when you come in and do exactly what's necessary and don't try to rush the lender. So anyway, they don't have to be limited to real estate. In other business contexts as well, they provide a flexible financing solution to bridge the gap between immediate financial needs and a more permanent funding arrangements. So anyway, that's kind of the way they're used, and I told you this was kind of short. You know, it can be used for that. I've seen in banking it used a lot for businesses when they need to go ahead and acquire, let's say they have a big project, but they need to acquire the inventory first before they actually do the project, and they have to do it quickly to get the job. Other times maybe they have to buy equipment to actually do this job. So if they are already signed up for the job, they can't get the job and then not know if they're going to get the equipment. So a lot of times they would like to get the equipment in the process of getting the job and get it quickly, get it fast. And then, like I said, in real estate, it's used all the time, you know, especially with individuals when they're, you know, wanting to buy a house and they haven't sold their house yet, so they can buy the new house. They give them bridge financing until they sell their house. When they sell their house, that money goes over there. So anyway, it's used a lot in business and in personal financing. Most banks have done bridge financing, and they'll know what it is. They won't have a problem with it. So anyway, please subscribe and hit the bell for notification of future videos. Please also like and share the video. And thank you. I appreciate it. My name is Roger Schlueter, and I'll definitely see you in the next video.